Stickman has been trying to invest, but every time he reads about funds, his brain crashes like an old computer. Mutual fund, index fund, ETF, hedge fund. They all sound like different types of soup. So today, Stickman wants to figure out what they actually mean. And don't worry, you won't need a finance degree for this. Just a few minutes and an open mind. We'll see how each one works, what makes them different, and which type might suit different investors. This isn't financial advice, it's education made easy.
Before we jump into all those fancy names, let's answer one simple question. What is a fund? Imagine a fund as a giant shared treasure chest, where many investors pool their money together. Now, instead of you trying to buy a few risky lottery tickets, which, let's be honest, is what picking single stocks can feel like, a professional manager steps in. Think of them as the captain of this treasure hunt. This manager uses that collective treasure to buy a whole library of different assets. We're talking hundreds of stocks, bonds, or maybe even real estate. The best part? You don't have to stress about picking every single investment yourself. The fund does all the heavy lifting for you, and you get to own a small piece of that entire library. When the treasure grows, you share the results with everyone else who joined in. Think of it, professional teamwork for your wallet.
Now, let's talk about one of the smartest, simplest ideas in investing, the index fund. Instead of a manager trying to beat the market, an index fund just tracks it. Imagine the stock market as a huge race. Instead of guessing which runner will win, you just bet on the whole group finishing the race. That's what index funds do. They mirror the performance of a market index, like the S&P 500. Because there's no manager picking individual stocks every day, index funds are called passive investments. That means lower fees, less trading, and often better long-term results than most actively managed funds. You don't need to be glued to the screen. You just buy, hold, and let time do its magic. Many investors love them because they're transparent. You always know what you own, the same stocks as the index in the same proportions. And since they trade only at the end of the day, like mutual funds, the system stays simple and predictable. Index funds are a great match for people who believe in steady growth and want to invest without overthinking every market move. They also form the foundation of many retirement portfolios, helping investors build wealth slowly and reliably. We'll see how each one works, what makes them different, and which type might suit different investors. Next, let's see how technology took this simple idea and made it even more flexible. Introducing the ETF. Now that we understand index funds, let's look at a close cousin, the ETF, or Exchange Traded Fund. Think of an ETF as a mix between a stock and an index fund. Like an index fund, it holds a basket of investments, giving you diversification without having to buy each stock individually. But unlike index funds, ETFs trade on stock exchanges all day, just like a normal stock. This means you can buy or sell whenever the market is open, giving you more control over timing and price. ETFs often follow an index, so many are passively managed, keeping fees low. Some ETFs, however, are actively managed, letting professional managers make smart investment decisions, just like in a mutual fund. Another big advantage of ETFs is tax efficiency. When shares are created or redeemed, the process can avoid triggering capital gains taxes, something that traditional mutual funds often generate for all shareholders. Because of these benefits, low fees, flexibility, and tax efficiency, ETFs have become one of the most popular ways for everyday investors to participate in the market. You can start with just one share and gradually build a diversified portfolio. ETFs are perfect for investors who want a hands-on option with real-time trading, while still enjoying the safety of diversification. Up next, we'll explore mutual funds and see how they compare to index funds and ETFs, especially in terms of management and fees.
At first glance, mutual funds might look similar to index funds or ETFs. They also pool money from many investors and invest it in a mix of stocks, bonds, or other assets. But the key difference lies in who's driving the car. Instead of following an index, mutual funds are often actively managed, meaning a professional fund manager decides what to buy, what to sell, and when to make a move. Their goal? To beat the market, not just match it. That sounds great, right? But here's the trade-off. Professional management comes with higher fees. While ETFs or index funds might charge 0.1% per year, mutual funds can easily charge between 0.5% and 1.5%. And those costs quietly eat into your long-term returns. Mutual funds also work differently when you trade them. You can't buy or sell shares instantly during the day. Instead, all trades happen once per day, after the market closes, at a price called the net asset value, or NAV. This structure makes them less flexible but also discourages short-term trading, which can be a good thing for long-term investors. On the bright side, mutual funds offer diversification, professional management, and strict regulation, making them a reliable option for investors who prefer a more guided approach. In short, mutual funds are like having a skilled driver take the wheel. You pay more, but you get someone steering for you. Next, we'll look at the high-speed, high-risk world of hedge funds, where the rules and the rewards can be very different. Now, let's enter the more exclusive world of hedge funds, the private clubs of investing. Unlike mutual funds or ETFs, hedge funds are not built for everyone. They're usually open only to accredited investors, people or institutions with high income, high net worth, and plenty of financial experience. Why? Because hedge funds can use complex and risky strategies that most everyday investors shouldn't touch. A hedge fund manager isn't just buying stocks and holding them. They might short sell, use leverage, or trade derivatives, all to chase higher returns, no matter what the market is doing. They can bet on prices going up or down, and they often move fast. That freedom allows creativity, but it also means more risk. The fee structure is also different. Most hedge funds charge a 2 and 20 model. 2% of the total money managed every year, plus 20% of any profits they make. It's great for the managers, not always for the investors. Because hedge funds are less regulated, they have room to take bold bets that could either make millions or lose millions. That's why they're often compared to race cars. Powerful, exciting, but not built for everyday driving. In short, hedge funds are designed for investors who want to take big swings and can afford to miss. For everyone else, slower, steadier options like index funds and ETFs are usually the smarter route. Next, let's wrap it all up and see how these different funds fit together in the big picture of investing. Alright, let's take a step back and put everything together. We've talked about index funds, mutual funds, hedge funds, and ETFs. 4 different ways to grow your money, each with its own personality. Think of it like this. An index fund is the calm, steady friend who quietly grows over time. A mutual fund is the professional who thinks they can outsmart the market. A hedge fund is the risk taker, driving fast and taking sharp turns. And an ETF is the flexible one, efficient, low cost, and always ready to move. So which one's best? Well, that depends on you. If you want simplicity and long-term growth, index funds and ETFs usually win the race. If you enjoy active management or believe in a fund manager's skill, mutual funds might suit you. And if you're an experienced investor with a high-risk appetite and deep pockets, hedge funds could be your playground. The most important thing to remember is this: you don't need to chase the perfect investment. What matters is finding the one that matches your goals, your timeline, and your comfort with risk. Because at the end of the day, investing isn't about timing the market, it's about time in the market. So stay patient, stay curious, and keep learning. And hey, if you found this helpful, give the video a like and subscribe for more simple, visual finance lessons. It really helps more people discover the channel. Drop a comment below and tell us which type of fund you use and why. Thanks for watching, and see you very soon.